The thing that I kind of knew anyway, and I would urge other people who are looking to go on an entrepreneurial journey, is don't give up. Probably won't go right first time. It might not go right the first 5 times because life isn't like that. It's hard, tough to do these things. Very few people, make any business success.
You have those proud dad moments, I'm 100% sure. What about when there are some challenging times with investments, decisions? How do you solve this?
That's where the creativity and the resilience is so important, because times it would be easy to give up on an asset. You don't want to do that. You want to keep fighting for it. You want to do the best for your investors, and just keep pushing and pushing as much as you can to turn something around.
My guest today is Ian Rickwood, founder and CEO of Henley Group. Ian's career jumps off the page from learning there is more margin in the lease than in the sandwich, while scaling Subway locations, to taking Benjys from a family business to a citywide chain, and then building Henley into an investment platform where they back entrepreneurs and develop thousands of UK homes. Thanks a lot for coming to the Holdco Builders podcast, Ian.
Pleasure. Good to be with you. Looking forward to it. Thank you.
Let's start with you giving us an overview of the scale of the investment firm, industries, projects you're working on, of what you and your team have built over the years, and then we'll go through this step by step.
Sure. So Henley is a business that's been around for just about 20 years now. We've deployed about $4 billion of capital. So, significant, not huge, but significant, across a broad range of assets in that time. So within the European side of our business, we operate both in the core end of the market. So we have 2 discretionary funds that have LGPS capital and corporate pension fund capital in. And then we operate at the value add opportunistic side of the real estate market as well. As you say, we're a fairly large developer, building out or controlling at the moment something like 12,000 homes within the UK. And then we also operate across other parts of the commercial real estate market. So, historically, we've done quite a bit of office, we've done some student, we've done some industrial and some retail. So a real range of different classes. And then within the US, we had a value add opportunistic real estate business that did very well up until 2021. We bluntly, were fortunate with timing. We executed our plans well. We sold most of our assets in 21. We're ready to go again in 22, just as the Fed started to raise rates and realized that, you had a falling knife situation. So rather than try and catch it, we sat back, and whether it's quite hit the floor at the moment, I'm not sure. It must be close, but we're just about getting ready to go back into the US market on the real estate side. And then we had a car wash business as well, which I'm sure we'll talk about later. So fairly diversified group today, with employing 60, 70 professionals on the real estate side, and then building out a much larger scale people business on the car wash side.
Okay, great. So it all started from somewhere. It's year 20 for you. So what were you doing before founding Henley Group?
Yeah, so very briefly, my background, degree in economics, joined Procter & Gamble back in 1989, a long time ago now, as a sales person on their graduate scheme. Spent 4 years at Procter, really enjoyed it. Great company, wonderful people, learned a tremendous amount, incredibly process driven, great marketeers, just some very smart people, many of whom have gone on to much bigger and better things than I have. Really good peer group to work with. Left Procter to go to Pepsi. Previous boss of mine from the firm had moved over to Pepsi and encouraged me to join them. Equally, a great business to work with, wonderful people, slightly different culture. So if Procter were very process oriented and very rigorous in what they did, and very good at the marketing and very logical in their marketing, you may remember, those who are familiar with advertising, it always used to be the green line adverts for P&G. So we're always selling the benefit, the superiority of product over the competitor, with the green line down the middle. Here's a competitor, here's us. A lot of their advertising at that time, at least, was driven like that. Pepsi was slightly different, more entrepreneurial spirit at Pepsi, I'd say. Within Europe, it was a syrup business only, because it worked predominantly with franchisees who were the bottlers. And so we were managing the franchisees at the time and doing the European wide and supporting the global marketing activity. So it was a smaller team, highly profitable business. But great fun, and they just had, just some of the creativity around the marketing. Some of the promotions that were run at the time were very groundbreaking, and learned a tremendous amount from both businesses. And that's where I met my what was to become wife, future wife, and I had an entrepreneurial itch. So did she. We, kind of thought about what we could go on and do. She was working at the time in the PepsiCo restaurant business, and having previously worked at the Pepsi bottler in the UK, and before that at Coke. And so I had good, strong marketing and sales background as well. And then I came across Subway, as you mentioned at the beginning. And Subway were looking to expand in Europe. I was at the time a European sales and marketing director for Pepsi. So I was introduced to them through the US connections. Pepsi were their, soft drink supplier. So we were wanting to support them. So I learned a lot about that business. Hopefully we helped them in a good way to really succeed within Europe. As well as that, we sort of saw the opportunity to take on the master franchise for, at the time, what was half of London. And so they agreed to do that deal with us. And we were pioneers then of Subway within the United Kingdom. And that was back in about 1994, I think, something like that. So.
Okay. And how did you win this contract? Because I guess there were other people who wanted to do it as well. And this was the moment you left your job, right? To go full time on this?
Obviously, to get what was called development agent rights, which essentially gave you a master territory that you could then either run your own stores or could run franchisees. So go and find franchisees and act as the local agent. So it was effectively a pyramid system that they operated. Obviously, one had to be qualified to do that. We were very young at the time, and we were 26 years old or something, and not super well capitalized. Although we did get some third party money in to help what we were doing. So there was definitely a question mark probably over our age, but what we didn't have in age, we made up for in enthusiasm, I guess, and some other credibility with what we had done and experience of what we'd done so far in our careers. And so, we were able to win that opportunity. Yes, they did talk to other people, but we were early in it. We obviously had some relationship already, so we were able to be selected as a development agent, for that. And so that's really what got us started. And sorry, your second question again, I've forgotten what it was.
No, that was all it. Now I just wanted to go about the lesson you learned, and when did it actually happen that there's more margin in the lease than in the sandwich?
Yeah, so we got the first. Oh, sorry, I know what you're saying. Did we both leave our jobs? So, and a good little tip for entrepreneurs, I'd say, particularly people who are doing stuff together. And there's another example of someone else from Procter who did something similar. So I stayed in my job for longer, and Emma left. That was the way that we got going. So she was in it full time. I was in it outside of my Pepsi hours. And then when I finally left Pepsi to join, I also sort of did some consultancy for a period of time so that I could supplement, because as any entrepreneur will tell you, in the early days, you don't take much out. It's all going in from a capital point of view. And so things can be fairly skinny. So that in that survival period, we sort of ran a hybrid, and I know a guy called Richard Harpin, who you may have heard of, who created HomeServe and was another Procter guy, a couple of years ahead of me. He, and again, had many different businesses that he tried to invest in before he found the one that was a great success for him. He also had a partner, and his partner was Jeremy Middleton, and Jeremy stayed in employment all that time, so that the pair of them could, create the business together. But one of them focused not earning, the other focused on earning, in order to try and kind of lighten the burden that goes with it. So a useful tip, well exercised by many entrepreneurs. On the opportunity, it's like any, and I may come onto this again in terms of the new things I've learned about the car wash business since we've been in that. But whenever you go into a new sector, invariably what you learn, or what you have learned on paper and thought about and underwritten, when you actually get into it, things are always different. There's always new stuff that you think, why didn't I think of that? Or why didn't I see that? Or why didn't I know that? And that's a great thing with when you go somewhere new. In this instance, I really wasn't particularly aware of real estate economics back in, what would have been 1997, I guess. And we were working with an agent to try and find leases for us. And the agent did a very good job. We found some great stores to begin with that we just took a long-term lease on. And it was only, in talking to him about that and thinking about it, that you realize when you were taking an empty store and you looked at the capital value of an empty store, at that time, it might be priced at, something like a 9 or 10 yield if it was vacant against what the theoretical rent was for it if it was occupied. Once it was occupied and there was a 10, 15, ideally 20-year lease on it, then that yield would move down from 9 or 10, back then maybe to 7, 6, something like that. And the Subway name was well regarded, even though in reality, the actual credit of the tenant wasn't Subway itself. It was our franchise business. But nonetheless, there was a halo effect and a belief, I guess, that if there was a default, somebody else would step in and run the Subway. And so, yeah, you got that big fall in yield. And as you know, obviously, capital value is inverse to yield. So as the yield came down, capital value went up. So, yeah, we were able to then, after that, start not just finding stores, but finding stores that we could purchase. And so, we quickly learned that on if you're buying a store or buying a piece of land, a shop to fit out for, let's call it £750,000, and you could get that kind of yield compression, then the value very quickly would rally up to, maybe 1.5, something like that. So kind of doubling the value of it very quickly. So that was an easier trade in many ways than hours and days and years of selling sandwiches at what was much closer to, I think at the time, a gross margin was pretty good, probably 60, high 60s. But by the time you took off labor, rent, rates, utilities, and everything else, you probably got down to a net margin of 15% on that business. So yeah, you had to sell a lot of sandwiches to make $750,000 from a single store.
And how long was this journey from you, from finding the opportunity, the Subway opportunity, and then did you exit, or what happened eventually?
Yeah, so we got up to about 16, I forget exactly now, but 16, 17 stores, something like that across London. Our strategy at the time was to own the stores rather than franchise. So that required a lot more capital. And at the time, the banks were only just getting into the space, so it required more equity because the brand wasn't as well known, obviously, as it went on to become. But if we were at 16, 17, I think at that time, the next largest development agent probably had 2 stores in their area. So we were materially larger than everybody else. We put more capital in than everybody else. It was great for us. It worked out well, but we were just misaligned with the rest of the UK at that time. Our ambition was greater. And there were frustrations of being within the franchise, and we wanted to go and do it on our own. So we decided to exit that business. So we sold it. And at the same time, then bought into Benjys, which you mentioned, which was an existing brand, which at the time had about 27, 28 stores, something like that, in central London only. We bought that from a family. It was an interesting experience, an awful lot of learning. But we bought that in 2000 and grew that from 27, 28 stores. At its peak, we got up to about 90 stores. Interestingly, we weren't all company owned there. We did franchise. And we also developed a mobile concept, which we called a vanchise. And I think we got to just under 200 of those. So we went out and worked with a team on creating a bespoke adapted Vauxhall van with a coffee machine on it, to do really good espresso coffee, which was quite revolutionary at that time, and a hot area and a cool area. And we'd go to industrial estates and office parks where there weren't necessarily catering facilities and provide catering for that. And that was a franchise business that grew very rapidly. So yeah, we got to about 2006, but for us that wasn't such a successful exit. I think we were very happy with a lot of the changes that we made to the brand. It was, when we took it on, it had no real accounting. It had various tax investigations. It was all cash at the time. There was no real controls in it. It had just moved into trying to manufacture in a central production unit, which wasn't being properly run, frankly. So we had to put a lot of investment and time in putting the processes, the controls, and the regulatory standards that were required for production. And that was a very grueling experience and required quite a bit of capital. And unfortunately, all of that was good. And, I think the brand changes that were made were good. The thing that really hurt that business and ultimately hurt the exit value was of those 27, 28 stores that we acquired originally, nearly all of them ended up having a small format Tesco, Sainsbury's or Marks and Spencer open up next door or within 50 yards. And we quickly observed that when one of those mini supermarkets opened up, doing what we did, but on a bigger scale, and obviously able to operate at much lower margin, what we found is we lost 30% of the trade immediately. And maybe we were able to claw our way back to kind of an 18% decline or 17% decline, something like that. and we were never able. And once you took kind of that kind of level off of the top line, 15 to 20% off of the top line, suddenly what was a profitable business was no longer a profitable business. And again, more stores. This was back in 2000, early 2000s. More stores were trying to take up space in central London at that time, so rents were pushing up. We didn't own the stores; they were all leased because they were prime retail. Rents increased significantly, so you had a big reduction in revenue, big increase in rents, and suddenly stores that were profitable became loss-making. And so all the activity we were doing to get out of London on the franchising side and on the van side couldn't grow quickly enough to offset the damage done to the core. To the core of the business. So in the end, we had to sell that. So we sold it in 2006 and to somebody who, originally we were going to stay in the deal, but they decided they didn't want us in the deal. So we left shortly thereafter and had a couple of days off and then kicked off with Henley back in 2006.
If you go back to the Subway exit, was this the life-changing money for you at this time? At the time?
No, it wasn't. No, it wasn't at that size. It was significant, for our age. It was significant and it was helpful. But we plowed a lot of it back into the next deal anyway, rather than taking it off the table. So no, it wasn't.
After both of those businesses, Subway and Benjy, what you knew you were good at before starting the next thing, before starting Henley?
Well, again, you learned a lot. So you sort of had this corporate background, which was very good at structuring process, memo writing, thinking, organization, all those sorts of skills. And frankly, people management as well. They were both very good at, you ran teams and they're both very good at learning how to manage people and different types of people. And then when you go into a more entrepreneurial environment where you don't have the same controls around you, you don't have the same, frankly, quality of people and quantum of quality of people around you, you really obviously build the entrepreneurial muscle. You build resilience, you build pragmatism, you build creativity because you come across more problems than you recognize. I learned a lot more about financing. I'm not a trained accountant, but fairly numerate. And I just got into that in a big way. I learned about capital structures. I remember being first introduced to private equity and just recognizing how private equity worked and, the importance of leverage in a deal and the right leverage in a deal. And then, things like waterfalls and all of the other aspects that go with private equity to try and drive returns. So there was just a whole host of things about running a business and about making money, so acting as an investor versus working as a manager in a corporate environment. So those are the sorts of skills that were really honed as we built out our own companies.
Now, when we take year 2006, the birth of Henley, what was the founding thesis, your age, and what did you decide to do?
Yeah, so we were a bit battered, I think, at the end of the Benjys experience. It was quite difficult at the end, and it, when you're in a slightly distressed situation, which we were when we exited, it's obviously very draining. And bluntly, our primary concern was trying to get the business overhauled to somebody else and to minimize any damage from job losses and things like that. So, and we did that successfully. So we were very pleased about that. But we were tired, we were fatigued. It had taken an awful lot of creativity because you've been fighting this rearguard action for a number of years. So we certainly learned the concept of pivot, through that experience and resilience. But that was fatiguing. So when we first got to Henley, the idea was, it was my wife and I again, and we said, well, why don't we just have more of a lifestyle business? Why don't we, she had retrained at that time in architecture, interior architecture, so design, product. We'd obviously built a lot of stores at that point, so we knew about construction. We'd learned about real estate, from our experience that we talked about earlier. So real estate was a natural place to go. And we bought a first house that we were going to do as a single family home. It was a redevelopment in the Surrey Hills near Guildford. And we would buy it, get consent for it, planning consent, build something new, and then sell it. And we thought we'd just do that. We thought we'd do maybe a couple of those a year, have a nice little business, maybe make, I don't know, £500,000 pounds a year, something like that, a profit. And that would be a nice lifestyle. And we did. And that was the start of it. I think, however, when you're wired the way that we were wired and you've gone through what we've been through, you get bored quickly doing that. And you realize that's not well, for us at least, that wasn't super satisfying. There was more capacity, energy once we sort of, recovered to go again and to do something bigger. So that was one driver. And then secondly, the GFC happened. So let's say we'd got up to probably 4 or 5 assets, I think, going into the GFC that we owned, all residential, all redevelopment. And got smacked with a GFC. Obviously, values dropped significantly. You couldn't get funding. Nobody was buying anything. And so again, that was another really memorable experience. Now we survived that. It was very close at times because we were doing everything on our own balance sheet. And so coming out of that, we said, look, the idea of this nice little every year you make, £1 million, and you got a small business and, you're not working that hard and it's all very easy, we realized was a fallacy. So we said, no, let's go again. Let's go for diversification. Let's not just do the residential. Let's do some other things as well. And let's use not just our own balance sheet, but start to bring friends and family money in and to start to spread it out, because that will give us more scale. And so with scale, you get more diversification. And so that was really the catalyst for what Henley then became. So it was really from 2010 onwards that we really commenced our efforts on the commercial real estate market, which obviously we knew about from our Benjys days and Subway days. Really just pushed on in that space. We found some great people who supported us, trusted us with their money. We did very well with the early deals. And that was super helpful. And because they were going well, the people that had come in put more money with us and they introduced other people. And so it got some momentum. And then, through that growth, we were able to start hiring a team. And then, we had a very good run, really right the way through from 2010 right up until 2022. COVID was a bit of a wobble for the market. People weren't too sure, but we had a very good 12-year run. As the cycle was good. Obviously then since 2022 it's got tougher again, different to the GFC, very different experience at the moment, what's going on in real estate 2008, but still very challenging for the real estate market, and we can talk about that a bit if you like, in terms of how the different sectors are challenged at the minute. But so a good 12-year market. And in that time, I think if we were to look at our sort of 21 22, up in that 10-12 year period, I think back then our average IRR was running at something like 19-20%. Today it would have come down slightly. Today it's closer to 16-17 across all of our deals. So still very good. Obviously having gone through a fairly large down cycle over the last 3 years, but not as good as it was back in 21, 22.
Now you've been doing all this with your now wife, Emma. How has it been? I mean, the early days of you quitting the job, then both quitting the job and putting all the eggs in one basket. But there has been some challenging times as well. Like, how has it been for you on a personal side, on a relationship side, on a partnership side, to making it all work? Because you're at work together, you're at home together. How does it work?
Yeah, it's pretty unique, to be honest. I guess for a lot of people, so they can never work with their partner. Or their marriage wouldn't work if they work with their partner. For us, it works very well. I think the key to it is we have complementary skills and there's a high level of trust. So, Emma is fantastic at many things I either can't do or have no interest in. So, she's particular, and she's kind of wired in a funny way. She's incredibly creative. So she's a marketer by background, really into brand, into how we present ourselves, how whether that's on the Aquasonic brand at the moment that we'll come on to or Henley itself. So very, very astute marketeer, also very tech savvy, incredibly tech savvy. So quite nerdy in some ways when it comes to tech, and has been very helpful, as we build out the systems for the company and use of technology, within the firm. And again, even within some of our platforms, on the tech side. And then thirdly, she also enjoys wearing a hard hat and going around a construction site. So an amazing eye for detail because she retrained in that, and incredibly capable at negotiating contracts for construction, and actually walking a site and actually knowing what she's doing, much often to the surprise of what can sometimes be a fairly chauvinist market. So if I go to her with a site, for example, and that we're meeting the contractor and the contractor's not met us before, you can be sure they'll start talking to me to begin with. and then I'll say nothing, and then Emma will pipe up, and suddenly they'll look around, and you'll see this confusion, on their face. So she's very good at those things. Has zero interest really in the financials of something. I mean, I'm exaggerating, but that's not her happy place. I mean, so whereas I am very much into the numbers. In some ways we joke, she's colors and I'm numbers. It's kind of how we that's how we kind of split it. And so when it comes to deal structuring, when it comes to capital structuring, when it comes to strategies, to execution strategies for a given asset, when it comes to the breadth of what we're looking at, all of those things are really areas that I really enjoy and thrive in. And she's very happy for me to crack on with that. So yeah, that complementary overlap. And there's, like anything, there's a Venn diagram of common bits in the middle, where we're both skilled and challenge each other. But there's an awful lot of white space where, she's very good and I trust her, and she thinks I'm good and she trusts me. And so that's kind of why it works, I think.
Now, you didn't stop there. You involved your kids as well in the business. So
we didn't intend to. Yeah, no, we didn't intend to. That was never the plan. But that's the way that it's transpired. First of all, our son got involved in the business some time ago, and we were cautious about that because we didn't want him to have an easy ride into it and to be treated differently. And so we have, he's done it the hard way. Starting out as an analyst, he got the opportunity because of who he was, for sure. But he then had to demonstrate that he was capable. And to be fair to him, he's done absolutely great. And he's knuckled down. He's nailed it, and is very competent. Done very well. And I stay well out of that. I've not managed him. He's been managed by others, and I've always given absolute freedom to his bosses to manage him as they see fit, to challenge him and not to disregard the name as much as they can. If it isn't working with him, to tell me, and that would be his chance gone. It kind of cuts both ways. On one hand, he got, the opportunity because of who he was. And in another way, he had to perform at a higher level because of who he was, because the grade, the standard expected was higher. So he's done really well. And then my daughter, she was out in Australia working in sales for a media company, for a television company, and she's very gregarious, very naturally a salesperson, great with people. And she came back to the UK, and she had 3 job offers, one in media, one for a football club actually. And she said, well, what could I come into the family firm as well? And we said, well, why do you want to do that? She said, well, I think it'd be fun. I'd like to work with you guys. And we had an opportunity at that time for her to come into the investor relations side. And because of her skill set, that was a natural place for her to go. Yeah, so she came in and started looking after our high net worth investors, kind of retail investors and family office. And she's now been in the business for 2 years. And again, you're very natural at it. You're very hardworking. Takes the responsibility of being a family member in the company really well. And so yeah, they're both in it and both doing very well, and we're incredibly proud of them for doing that. But they weren't pushed into it, and they would be free to leave if they ever wanted to.
You're a very lucky man. It's so awesome to hear a story like this.
Yeah, I think we're very blessed. Yeah, we do appreciate that. Yeah.
You have those proud dad moments, I'm 100% sure. But what about when there are some challenging times with investments, decisions? How do you solve this? Because it's obviously a bit different having those hard conversations with your kids compared to, let's call them just a simple colleague.
Yeah, I think you can distinguish, can't you, though, between... There's always going to be challenging deals. Anyone who makes a lot of investments is going to have, not every deal goes perfectly well. We all know that. And invariably, the deals that go wrong are the ones that absorb so much more of the time and energy. And, within what's happened in the real estate market since 2022, there's been plenty of challenges, plenty of fires to have to go and attend to. And we've been working our way, resolving those. And again, that's where the creativity and the resilience and is so important, because, at times it would be easy to give up on an asset, and you don't want to do that. You want to keep fighting for it. You want to do the best for your investors, and just keep pushing and pushing as much as you can to turn something around. And I think that's the mentality that we have as a firm. And that comes, that's from me right the way through. Everybody shares that commonly. So I think because there's, again, an alignment of culture and alignment of interest, whether it's our family or whether it's, the rest of the team, you don't really get big issues. You might get disagreements about the best way to solve something, but that's a good thing. I never want to be a sort of company where it's all top down and I say we must do X and everyone runs around doing X. That's hopeless. You want to make sure you're really testing and thinking and pushing when there's a problem to try and find the best pathway through. Once you've decided it, you then want everybody on side doing their bit of execution to try and do the best we can with it. But in the discussion piece, at least you want as much debate as you can get. So we'd encourage that. So I don't really get an issue there on the performance of an asset. I guess where you might get an issue is on the performance of the person. So if they're not executing in the way that you want them to execute on a deal, and look at it, you only know kind of what you believe you're doing. Other people may see it differently. But I would say generally, I'm probably tougher I'm tough on myself, and I get very irritated if I've made a mistake or done something or not done as well as I could have done with something, because you want to try and deliver a very high standard all the time. And I probably place that responsibility on everybody in the company, but even more so on family members, and they have to put up with me outside of work hours. So probably it's a bit tougher for them than it is for people who can go home and ignore me. I don't think, it's not a challenge that I am aware of as being different for the family as it is for anybody else in the company.
Okay, this is a great answer. Now, when it comes to having geography as an edge, so when did you expand to outside of UK? Currently, you're in Poland, Ireland, Germany, Netherlands, and US. So what are maybe some like cross-border advantages, disadvantages, and why you decided to make this change?
So it was opportunistic more than anything else. So we... I'm trying to think what the first deal was that we did outside of the UK. It was probably with a partner in Holland, I think, back in about 2011. So we came across somebody who had some good experience, knew that market, had some interesting deal flow. You'll remember after the GFC, the capital markets have been really damaged. A lot of firms had disappeared altogether and previous capital relationships didn't exist. And so one of the things that we saw early as an opportunity was to co-GP with people. So we'd set ourselves up to behave institutionally and try and put institutional systems in. Lots of companies that had disappeared, people were starting up as entrepreneurs again. They didn't have any capital. The previous capital relationships they had gone. They weren't necessarily institutional in their approach. So we could work with them. They could find deal flow and have operational capability for that particular asset class. And we could put a wrapper around them effectively and institutionalize them and help raise money and then put some of our own capital in as GP capital. So that was the proposition. And we found some good people. And one of the first ones we found was a group who could do something in Holland. They had a good deal. They had an interesting play. And so we did several deals with them in Holland and in Germany. Yeah, that kind of got our foot into the door. And then from that, once we were doing it, others came forward, and so we created other partnerships with other people. And then, as you say, it took us to a whole range of different markets across Europe, including Germany, Holland, Poland, and Ireland. And then it was exactly the same. At the time, we had a home in Florida and enjoyed spending time in the US. And so, my wife and I said, well, why don't we try and create a business in the US as well? Slightly cautiously, because it had been somewhat of a graveyard for European and certainly British businesses in the past. There are a number of British real estate companies who'd gone over to the US who'd been burnt. We wanted it cautiously, and we found a partner at that time over in Boston, and he had left institutional capital, created his own platform, was looking to try and scale that, and so we joined forces with him and created Henley USA. And then bought an awful lot of assets over a very short period of time, particularly in the multifamily space. And as I say, did very well. It was all value add and did very well and sold it through 2020 to sometime early 22.
For a long time, you did deal by deal, but when and why you decided to raise a fund?
Yeah, so obviously deal by deal is a good way to start. It's probably a very necessary way to start. And it's interesting just with how the kind of fundraising market is at the moment as to whether more people are going to have to go back to doing that because fundraising has been so difficult unless you're one of the giants of the industry. So we did it out of necessity to begin with. And it's difficult because often you're trying to get the deal, then you're trying to line the capital up. You have some of the capital, so you can put some early stuff on balance sheet, and then maybe you're selling down off, from your balance sheet. So there's different ways you can structure it to try and get deals done. But it is definitely harder work doing it deal by deal. There are big advantages to deal by deal as well, i.e. less stuff is crossed. You've got more timing flexibility. You have less restriction from a mandate point of view, so you can be more opportunistic and flexible as markets move and adjust. So there are advantages, but there are disadvantages. But no, the opportunity really came. We had a division at the time that was called Henley Healthcare, and we'd identified a space in the market with a couple of guys who'd introduced it to us, who we co-GP'd with, and they'd identified that there was a burgeoning need for housing for vulnerable adults, so people with a physical or a mental disability, who predominantly either were living at home and being cared for by parents, or more so in institutional care at great expense to the state, and frankly inappropriately housed as well. So the opportunity was to provide permanent long-term housing for people who qualified, and there was no private capital in that space at all. And so we got going in and really to help create the category back in 2011, 2012. And it was a complicated sector to be in because it had multiple counterparties, including the local authority, the underlying individual, a care provider, and a registered provider / housing association. So you had multiple groups you had to line up to make things work. But we were able to do that on scale, and create a category. And we were really operating at the opportunistic end to begin with. So we were trying to, bind all these things together and find a property and fit it out. You made opportunistic returns from doing that, but you carried quite a lot of risk and quite a lot of friction in making all that happen. But quickly what occurred was one or two funds liked the space. And so we started to sell into those funds. And we just decided to pivot to say, rather than doing the opportunistic end, why don't we become a permanent long-term capital partner? We like the space. We like the good that it does. There's lots of advantages to it. And so that was the cause. And we were able to go and raise our first fund with the support of one of the major consultants who were able to put some of their clients into the fund. So that's what kicked it off. So it was opportunistic in itself, out of something that we'd already done. And then going forward, I'd say, we'd be open to doing more funds, but the environment at the moment is not easy for fundraising. And so whilst we are thinking about a couple of things at the moment that will be an adjunct to what we've already done, because that'd be the most natural thing to do, I think that, focusing on doing deal by deal is probably going to be the easiest execution over the next couple of years.
Now, I want to understand your take as you understand the current market, the fundraising market. There is this large deal which just went through yesterday. Electronic Arts, which is a EA, went private for 55 billion, and there is a story that Jared Kushner was involved with the Saudis, and but an interesting take. Someone tweeted, I'm just reading it out. There's a lot more capital in the world than there are people with good ideas and strong enough conviction to use it up. A big lesson from private markets is that having large AUM ready to rip doesn't get you much. The best deal guys are capital light and conviction heavy. Based on your experience, where are we today, and what is your opinion on this?
It's an interesting tweet, isn't it? Who said that? Anybody well known or?
There is a guy. He's large on Twitter. His name is Will Manidis, and he's I think tech investor in US. But yeah.
Interesting. Yeah, look, I think that one of the things I always say to my guys is it's all about the deal.
Mm-hmm.
All about the deal. Good deals are harder to come by than capital. So I agree with that. If you've got a good deal, it'll always find a home. So therefore, the front end of the process always has to be the deal, not the capital. Some people say, "Oh no, go raise the fund." Then yeah, sure, but you're probably then, and that has worked when it's been easy to raise money. That has worked in the past, and some people are focused on that, and maybe they're all about AUM, and then they clip fees on the AUM, and they build a very nice business from it. If you're up at, several billion of AUM, and you're clipping a point or point and a half, maybe 2 points if you're very lucky, that can add up to be an awful lot of fees that are coming into the management company. So there's obviously merit for people who are doing that. I get that, but it doesn't. The watch out, as you know, is, and as you kind of said there, is if you're sat with a lot of capital and you have to deploy it, or you're going to give it back. Because if you don't deploy within a certain window, maybe it goes back. That can create a need to chase. Now, I don't always see that, but you do see people making mistakes. I think an area at the moment that probably is vulnerable to that is the credit market. There's so much money that's moved into private credit. We saw on an asset we had recently, we put out to the market for funding on, and we were overwhelmed with offers of financing. And of course, everything gets bid down, and leverage gets bid up, price gets bid down. And so ultimately you wonder whether some of these funds will ever, A, will they all be able to deploy? I doubt it. And B, will they end up taking far more risk than what they probably underwrote to and possibly, suggested to investors? I think they will do in order to make the return. And so those are the watch outs. But yeah, I'd agree with the statement. I'd say, if you've got a good deal, you'll always find a home for a really good deal. So that's the place to focus.
Hey, a quick break from the episode. I want to talk about today's sponsor, Capitalbad. Because if you listen very closely what Ian said, it's all about the deal. If that is true, today's sponsor, Capitalbad, makes a perfect sense. It's a marketplace built for acquisition entrepreneurs, where operators list live deals and investors can browse and fund them. And Capitalbad handles the messy part, standardized terms, governance, distributions, all up front in black and white. So it's your job just to go through the deals, make the analysis, and then make a commitment whether to apply, invest, or not. So if you're raising capital to buy a business or you want exposure to acquisition deals, go to capitalbad.com, sign up, see the deals, and make your own decision. This here, it's not an investment advice, but if you want to learn more, go to capitalbad.com. Now, back to the episode. And now next, if we take those special people, those talented operators on the value add, opportunistic side, what does a perfect entrepreneur operator partner look like for you?
I don't think there's not just a single description. I've seen them in all shapes and sizes. But the types of things that we think about when we meet somebody, first of all, you're looking at either the deal or the niche that they're promoting. So you're trying to get a view on how good is it, what makes it particularly good and attractive. Obviously, very focused on where the downsides are with it. If it's a niche and new market, you really want to learn about the market. And I'll come on to car wash in a second because you get some interesting experience there. But you really want to learn about the market. That's really important to make sure you know how large it could potentially be, whether it's the space you're in, whether you can institutionalize it, who's going to be the takeout, who's going to actually be the exit on it, in order that you can obviously realize the gain. So those are the types of things that we think about when we're looking at a sector or a niche or an individual deal. And then character is obviously very important. So track record of the individual, type of character that they are. We often do, testing with people to try and learn a bit more about them. And we do that for all our employees. We've done that in the past with some co-GPs as well, just so you get a better handle on where their relative strengths are and the watch outs, so that you kind of know the gaps that you might need to fill. And then, within that character piece, you're obviously looking for very high integrity. You want to know that people are going to be honest and straightforward with you. So when it's bad news, you want to hear it so that you can get onto it early and try and do something about it. And you obviously trying to avoid people who, shy away from, who I guess are only in it for the money. Those are the people you're trying to shy away from. You want people who are you don't want people who are trying to do a vanity project either, because that can obviously go horribly wrong. But you don't want people who are purely in it for the money, because the worry would be if something does go wrong, they'll get distracted and go off and try and do something else. So you're trying to find that balance of character with high integrity. And that's not always easy to do. And it's often only in the more difficult times that people's true character comes out, unfortunately. But as a way of trying to mitigate that, certainly thorough research on the individual, and ideally even testing on them, you could learn a lot from that.
You're super busy with everything. So if you have a 60-minute meeting with a person like this, what maybe signals, positive or negative, you will see, or which will show up, because you have a lot of experience finding those right people and finding maybe not the best people. So what is something you look at? You're
looking at how effective somebody is. If it's a new meeting, you're looking at how effective they are at getting their message across. So are they, because that gives you some insight into how their brain works. So that'd be one thing. So are they clear? Is it logical? Does it make sense? Have they been able to pass that information to me in a very effective and efficient manner? Or have they gone around the houses to get there? And has it been convoluted? And, therefore, does that suggest a slightly muddled thinking or muddled brain? So that'd be one of the things I'd look for. Secondly, you're looking for obvious errors. So I'm pretty quick with numbers and can triangulate data fairly quickly. So when someone's talking, you're looking if there's any, frankly, BS coming out from them. That's always something. If I see that, that worries me. I'd be, if it was an important meeting, you'd obviously have other people in the room. So you're looking to hear what their views are. So you can triangulate data points from other people who might be speaking less and watching more. And that's always a good guide. And then you're looking for, people who, again, come back to the character point. If someone's incredibly arrogant and that comes across, if it's all I, then that would be a potential watch out. So there's a number of things that we would look for, but fundamentally it would be that ability to communicate succinctly, get the point across about what it is they're trying to do, answer questions really well, ask good questions of us, because that again tells you how much they thought about it, and then watch out for those BS factors or arrogant factors.
Now you have so many opportunities coming to you, different industries, deals, but you chose car wash and car wash platforms. First of all, how do you yourself learn about the market to really get the perfect overview? Do you have like a specific process of doing this, or you start reaching out to specific people to get the information, and then you can maybe share like why car wash and what makes it so special?
Yeah, so we got into the space back in 2019. We got introduced to it in 2018 by a couple of guys who showed us some of the macros. I wasn't really aware of it, frankly, up until then, but we liked it. It looked interesting. We were very surprised at the margins. The margins were very good. And they talked about this membership model, which had just really only been around a couple of years at that point, been kind of launched by some of the operators, and was fairly new. But it made it interesting because obviously it generated more, a more recurring revenue. So good recurring revenue, high margin business, made it interesting. That was the first thing. We backed these guys who'd spent some time on it. We backed them and they started toward the end of 19. COVID happened. Communication was difficult. Movement was difficult. And so we bluntly weren't as on them as much as we should have been. And the strategy they wanted to pursue was a, lipstick on a pig. So buy existing, spend money on them, turn them around, put it under a new brand, grow the revenue, and then, therefore the earnings, and look to have some arbitrage on multiple. But in truth, they overpaid, overspent, and weren't good operators. And we quickly realized this after about a year, so sometime toward the end of 2020, and recognized that they bought the wrong assets. The plan that they had wasn't working, so we had to remove them. We then spent another 6-9 months trying to figure out what we could do to optimize what we had, cut back some of the capex on the ones they hadn't done. And by halfway through 21, we realized that that what they'd acquired was never going to work. It was not possible to turn it around. And it was things that are obvious now, but they bought sites on very tight parcels of land, under half an acre of land, express tunnels that, if you're really going to want to make high volume, high recurring revenue, large membership, you need to have ability to have a large tunnel to process the cars. And you need to have plenty of space for vacuums for people to clean the interior of the car. The sort of lot sizes they were buying, the tunnels were a third of the size of what we're building now. And they might have had 3 or 4 vacuums only. Whereas today what we're doing is 24 vacuums. So you're always going to be capacity constrained with what they were doing. You were never going to get the uplifts that they thought. And they didn't buy great sites either. And then they got hit by competition that was building much better units, not very far away. So we had to do a workout on that, and we did, and we got out, and we took a small loss on that, but at least we got out of the position. But we said, okay, look, the macros haven't changed. The execution was wrong. Let's not just do it as a co-GP. Let's do it properly. Let's build an organization. So, and let's become best in class. So we then spent 2 years going out, starting to put a team together, researching the market in much more detail, going to the best operators, looking at what best practice looked like. Get back to my P&G and Pepsi days. We did a ton of consumer research to say, okay, where's the need currently? How does the consumer think about this category? Who's shopping it? Who isn't shopping it? What's the frequency? What would drive frequency of shop? What are the big issues? What causes somebody to change? How much is it convenience led versus destination led? So we did a ton of stuff that you'd expect. You might pay a large, pay McKinsey or someone like that to come in and do. as an exercise for you. And then it was out of that work that we then launched Aquasonic brand. So this time we're doing it properly. We put a lot of money in, created a lot of IP. We've attacked the 4 big consumer issues that are in the market with the product that we developed with our own technology. We put together an outstanding team of professionals who've been in the industry a long time and the biggest, highest performing car washes. We've created great, brand equity with the brand that we've built. We've got marketing that is at a different level, frankly, to the rest of the industry, because you're applying P&G, Pepsi type, marketing capability to it rather than the traditional, what was very traditional mom and pop marketing. And so those are all the ingredients we put in. And then on top of that, using our real estate experience, we have put together, an incredibly adept, piece of software and AI to go out and to evaluate stores. So we're now, and it's expanded since I, first spoke to you, and these numbers will be out of date now. But as it stands, we look at something nearly 500 different attributes now to evaluate a store across about 100 different databases that we're scraping. Some paid for, some not paid for databases, and we're able to do that and produce an outcome from all that analytics to give an attractiveness score to a store in under 2 minutes.
Okay.
So we can look at things. We can look at things in a way that nobody else is looking at them, and it's very, very clever. Just the way we dial it down, and with any given site to look at the local competition, we rate all the locals, the competition, the sites that they're in, and look at them relative to ours. So who's got the best site within a given geography, within a given trade zone, and make sure that we're picking up the best site each time. And so I think our real estate capability is second to none. I think our operational capability is second to none, and we've built a brand out with a product that is really addressing consumer need in a way that other people have not been able to.
Now, you've been very openly talking about the mistakes you've made. Not too many people are doing it. Not too many people are willing to do this. What's maybe the most expensive belief you've changed maybe over the past 2 decades of doing it all? Because there are a lot of people listening who want to do what you're doing today. You're doing it for 20 years. So what I mean in here is that something you said in a very beginning was that it's just so different once you're doing this. Like first you want to do this, then you get into it, and you're like, okay, it's all different game, all different rules and everything. Is there anything?
So there's sort of situations. So there's sort of market, specific things. So yeah, particularly on car wash, we underwrote typical sort of PE. We did a portfolio model underwrite. So you have a series of assumptions, all of which you can validate, because you're going out, to build those assumptions up. But we did a top-down model as a portfolio model. Then when you open an individual store, you realize that the actual build-up of trade is different to what you put in a portfolio model. So you then go back and start doing a bottom-up. Now you end up at the same place. In fact, as we're now looking at it, having done our bottom-up modeling work, because we got that much more understanding now, we actually end up with better outcomes than was in our portfolio model, which is great. So we're really happy with the way that we're performing. But silly things like, we're opening stores in Florida. In July, August, and September, it rains pretty much every day. And when you first open a car wash, you have no customers. So everybody's a brand new potential customer. So they're a retail customer. They're not a member. So you've got to get somebody brand new to come and wash their car. And it rains 23 days out of 30 days or 31 days in August. So for 23 days, there's very little traffic because no one's coming in. Whereas when you get to year 2, you've already built up your membership base. Maybe you've got 3, 4, 5,000 members by year 2. Well, if you're a member, you don't care about washing your car because you know you can come back tomorrow again if it rains. It doesn't matter because you got unlimited usage. So therefore, who cares about the rain? But if you're a retail customer, you do care. You don't want to spend $20 or $30 or whatever to find out it rains on the car later. So that's an obvious fact, very logical. Something I hadn't thought about in that level of detail until we got into it. And I'm watching July and I'm thinking, why are the numbers so low to begin with in July? And it's only then as you come out of it and it gets drier in September, you see this great big hockey stick, and you then do the maths out and you go and get proper weather prints for the specific area you're in, and you look at the number of rain days there are, and you start to do a regression that's much more based on that, because that's a driver for your retail traffic, that you start to get new insights. So that's just an example of just a level of detail that you wouldn't be aware of unless you got into the market market. So, and there's lots of those that we've had as we've gone into stuff. I guess thinking kind of on 20 years, sort of big things. You're always learning. You're always learning. So, and you've always got to keep that mentality, I think, because there's always new stuff coming out. Whether that may be habits, or maybe habits. It may be management styles. It may be concepts that are new. And then obviously you've got technology. And I know you're very big in the technology world, and that makes you change because things keep overriding what you thought was normal practice before. But in terms of thinking about myself and my own style, I would say a couple of things. I would say on the learning point, probably continuing to be more open to listen to other people, even if you later discount what you've heard, but just, constantly triangulating new insights, new information, so that your brain is sponging up and soaking up is very important, because there'll always, amongst a whole load of stuff, there'll always be some gems that you can take out from that. And whereas when I was younger, I probably, sort of a little bit of the, arrogance of youth, perhaps. You're less open to that because you think you know everything. So, and as you get older, you realize you know very little. So therefore, learning from other people it would be one big thing that I'd take out. And the second thing that I kind of knew anyway, and I would urge other people who are looking to go on an entrepreneurial journey, is don't give up. Don't give up. It probably won't go right first time. It might not go right the first 5 times, because life isn't like that. It's hard. And it's tough to do these things. Very few people, make any business success are able to achieve it in an easy way, because that isn't the reality. It's hard. Have resilience, keep going, and be prepared to pivot. A really smart guy, is a good friend of mine, very seasoned PE guy, now retired, and I think he quoted, I think it might have been Warren Buffett who said it, said that a bad business will be a good management team. So, if you're in something that's not working, it's not right, it's not resonating with customers, consumers as it's positioned, it doesn't matter how good you are as a manager or execution person, you're going to really struggle with that. So pick winners, and be prepared to pivot if you need to pivot.
Ian, you covered all the 4 questions I had for you for the end, like with your talk at the moment, eye-opening stuff. Last one. What is your favorite book? What comes to mind?
Favorite book? Well, the book I read the most is the Bible. So I can tell you that's got the most wisdom in it of any book. Outside of that, I probably, because my brain is heavily wired most of the time, the stuff I read tends to be novels, and so it tends to be more action type novels. People like Grisham and authors like that. So more because I try to unwind when I'm not working.
Okay, it's an hour well spent. Thanks a lot for being so transparent with your stories, and especially the ones you failed and the lessons. It's, I think, again, not too many people are willing to share this. So, and the family part and the relationship part. Again, you're a lucky man, and thanks a lot for sharing your story today.
Appreciate your time. Thanks very much.